Markets are soaring higher today on better than expected retail sales, but I think the main story today is Walmart earnings and initial jobless claims coming in better than expected and initial jobless claims coming in lower than expected. Lee over on X calls this more evidence of a soft landing. Nick Timmerhouse writes on X that initial claims for unemployment benefits can be noisy, but dropped to a seasonally adjusted 227,000 last week, easing worries that the U.S. labor market is imminently rolling over. And claims overall are running around 2018-2019 levels. Retail sales month over month were revised lower last month from 0% to negative 0.2%. That was not great. Expectations for July retail sales, the data we got out this morning, was 0.3%, so positive. We came in at positive 1%. So including last month's downward revision, you were really coming in at about 0.8% because the prior estimate was 0%. So just take 0.2% off of 1%, you're really at like 0.8%, which still beat the forecast of 0.3%. So definitely some strong retail sales data that came out today, but I do think initial jobless claims is the main focal point of investors right now, really the labor market, because if we are going to go into a recession, you have to see the labor market deteriorate. And over the past 2 weeks now, initial jobless claims have actually been falling, which leads some evidence to maybe Hurricane Beryl did have an effect on your labor market report last month. I also think Walmart earnings were key for investors. This headline says Walmart beats estimates, raises outlook as it sees stable consumer health. The discounter raised its full-year outlook on strength in the first half of the year and said it has seen steady consumer health, but was more cautious about the second half. Walmart says, quote, "In this environment, it's responsible or prudent to be a little bit guarded with the outlook, but we're not projecting a recession." He said Walmart has not noticed a shift in consumer behavior. He said every month of the quarter was relatively consistent, and the back-to-school season is off to a pretty good start. Quote, "We see among our members and customers that they remain choiceful, discerning, value-seeking, focusing on things like essentials rather than discretionary items. But importantly, we don't see any additional fraying of consumer health." Walmart saw another promising indicator. Sales of general merchandise, such as lawn and garden supplies, were positive for the first time in 11 quarters. He said those sales were up only slightly, but were an encouraging sign for us. Walmart did also say it stands out to reason that customers are shifting to prepare more meals at home versus eating out. So generally speaking, Walmart had decent things to say about the consumer. The fear was Walmart would come out and say the consumer is slowing down in a material way. Walmart did not say that. Now, I do think to some extent, Walmart is the choice that everyone goes to, right? Especially even high-end earners. They're now going to Walmart. So Walmart's just benefiting from the weakness that is generally out there. And I really think Walmart's going to be like one of the last places to actually start to see a lot of weakness. Like if Walmart sees a lot of weakness, then we are in deep trouble. But I do generally speaking, think initial jobless claims, retail sales, and Walmart earnings create a pretty constructive backdrop for equities at this point. To say maybe some of the growth fears or concerns were a little overblown in the short term. Now, time will tell whether or not we are underappreciating the growth scare or we are just, if there is no growth scare. I still am concerned that equities are pretty much priced for perfection for 2025. So here in the medium term, over the next 3 to 12 months, I think there is going to be quite a bit of disappointment out there. I think there will be continued weakening, and I think with stocks priced to perfection, there's not much room for broader index upside. I think if you are someone that is bullish on the economy, then you really need to be in that broadening out trade. You really need to be picking stocks that are high quality, profitable, and beaten down. Dollar General, CVS Health, Nike potentially. These are all companies that should benefit from a consumer that holds up as interest rates start to fall. In other words, I think buying the areas of fear could be the best move right now. And a lot of the areas of our markets that are pretty fearful are consumer discretionary companies. So that's kind of the risk here. If the consumer does get worse, then I think those companies are priced for that already. So it may not be too bad, but it's a tough call. Because really at this point, there's so much conflicting data. On one hand, you have data that shows consumers are doing bad. Like they're not spending. And then on the other hand, you have retail sales that come in positive 1%, and you're like, what the heck's going on? But remember, it is an election year, and yeah, there's some tinkering with the data from time to time, in my opinion. Following the data that was released today, even Walmart earnings, the odds of a 25 basis point rate cut are 78%. Last week, the odds of a 25 basis point rate cut were 44%. So just a couple of days ago, markets were pricing in a 50 basis point rate cut as the base case for September 18th. Now the base case is for a 25 basis point rate cut and a 50 basis point rate cut. Those odds stand at 22%. So yes, there's 5 weeks until September 18th. Technically 4 weeks, 6 days, 2 hours, and 5 minutes until September 18th at 2 p.m. Eastern Standard Time. So there's going to be a lot more data. There's going to be basically one more of everything. There's going to be another retail sales. There's going to be another CPI report. There's going to be another consumer spending report. There's going to be another Michigan consumer sentiment report. There's going to be another PPI, all of it, okay? That's going to be the most important for determining whether we get a 25 basis point cut or 50 basis point cut September 18th. But perhaps I'm the first one to tell you a 50 basis point cut coming from the Fed is going to be seen as bad news by the markets. Because the last thing the markets want to see is the Fed that has to scramble to lower rates faster because the economy is weakening. The markets would probably like to see a 25 basis point cut. I think compared to the alternative of 50 basis points, 25 basis points looks a lot better in terms of forecasting what the economy is going to do. In other words, in simpler terms, if the Fed does 50 basis points, they're signaling more economic pain. If they only do 25 basis points, they're signaling less economic pain. And stocks trade around economic pain and what the economy is doing. If there's a lot of economic pain, if we go into a recession, then stocks are going to do poorly. If the economy does fine, then stocks will do well. I do want to share this with you, this clip from CNBC that says next jobs report will be a needle mover, says Charles Schwab's Liz Ann Saunders. This is someone we talk about and cover here a lot on the channel with her commentary on X.
Strong data. Our next guest does say markets are stabilizing. She does think a 50 basis point cut in September is still justifiable. Charles Schwab Chief Investment Strategist Liz Ann Saunders joins us this morning. Liz Ann, great to see you. I know you heard what Steve just said about that pad in there. What does the argument for 50 sound like?
Well, first of all, it may be justifiable based on how real rates have gone up. I don't think the Fed is going to do that. And I think today's data reinforces that the Fed's bias, at least at this point, is probably 25 basis points. I think the jobs report will be the next key measure. The Fed hasn't put inflation data in the rearview mirror, but they clearly have elevated the focus on the other part of their mandate, which is the labor market. So I think that could be the next potential needle mover for expectations around Fed policy. It's probably not going to be PCE because once you have CPI and PPI in the books, you can kind of map to what PCE is going to be, and it doesn't look like that will be an outlier. So I think the labor market will hold the key.
I'm looking at something JP Morgan wrote last night. Looking at the next jobs report, they say job gains in the range of about 160 to 200 would likely erase much of the fear invoked by the July print. Something in the low 100s, though, they say would put that risk balance back into growth and deliver a larger cut. Do those numbers make sense?
They do, but I think you have to go beyond the payroll numbers. I think the innards of the jobs report are at least as important as the headlines around payrolls. Obviously, the unemployment rate long-term unemployment, what you see in terms of wages, hours worked, the differential between the payroll survey and the household survey, and not just the print on payrolls, but what the revisions are for the prior 2 months, and any additional assessment about the benchmark revisions that are coming in the first quarter of next year. So I don't think you get anywhere near the full picture if you stop the analysis just at the payroll print.
You know, it's interesting because the Global Fund Manager Survey from Bank of America shows recession risk is the number one concern of these fund managers. Given the data that we're seeing this morning, are those concerns justified?
We will get a recession at some point, but I think this cycle has been unique in the rolling nature of it, and that's something we've been talking about and writing about for a couple of years now. You had recessions in key segments of the economy concentrated in 2022, housing and manufacturing and housing related, and a lot of consumer-oriented goods. You recently saw a little bit of weakness in services, but that seems to have bounced. So I still think that that's the best way to think about this economy. That said, in terms of the launch point for the hiking cycle, and historically how many quarters it takes for that to bite and help to bring on a recession, interestingly, we're right at that point right now, 10 quarters ahead. So I don't think we're past the expiration date on things like the long and variable labs in terms of monetary policy, the weakness that we've already seen for quite some time in the leading indicators, the fact that the yield curve went from a pretty deep and long-term inversion back into positive territory. Those are historically recession triggers. You've got the SOM rule. There's a lot that's different in this cycle. That's why I think people are reticent to say, boy, it's coming, just because of the unique nature and the rolling nature of this cycle. But when corporations are telling you that they're concerned about risk, then a recession risk, and I think it's something you have to heed.
How about getting back to the market for a minute, Lizanne? You know, it's only a few weeks ago when we saw rates break down significantly. I think it was a CPI report, I forget. And then we had that great rotation that lasted all of, a couple of weeks, where everybody was talking about small caps. Is that not sustainable? And are we back to a mega cap-led market?
Well, I think there's some sustainability in the some broadening out and some money looking for opportunities down the cap spectrum. But what I think you need to do as an investor is you absolutely want to fade any of the lower quality components of what you're seeing move in an index like the Russell 2000 and lean into the higher quality. You still have about an 18 percentage point spread between the performance of the zombie companies versus the non-zombie companies within the Russell 2000, obviously in favor of the non-zombie companies. So I just think it's really dangerous to think about small caps in any kind of monolithic way. There's a huge spread up and down the quality spectrum within an index like that. And there are times where moving down the quality spectrum makes sense if that's where the leverage is to a major upturn in the economy. That often happens coming out of a recession. I just don't think we're at that point in the cycle. So the opportunities may exist, but you absolutely want to stay up in quality, profitability, high interest coverage, strong balance sheet, strong free cash flow. That's the way I would approach any continued rotation.
I did find it interesting in that clip, she said eventually we will get a recession, which is still something a lot of fund managers and influential people like herself just are not saying. So I still continue to believe you want to keep a healthy amount of cash on the sidelines here, but taking advantage of high-paying dividend companies, taking advantage of quality names trading at 5-10-year lows makes a lot of sense as well. Something like a CVS, for an example. I think the closure of Rite Aid is going to help them out. They have their PBA business, which is unlike Walgreens or other pharmacies, so they're a little bit more insulated from that regard as far as pricing pressure from insurers. And CVS Health pays 4.5%. I mean, as the Fed starts to cut rates, I think your high quality dividend paying companies are also going to go up in price and their yields are going to come down. Because why own CVS if you get paid 5% in short-term treasuries? As the Fed starts to cut rates and rates go back to 3.5%, then CVS at 4.5%, makes a lot of sense. So I do think in the shorter term, over the next 12 months, before we do get more clarity on the economy, high quality dividend paying stocks, I think could have a lot of upside actually as far as share price appreciation. Because dividend yield is ultimately based on risk in the markets, right? Or company risk specifically. Now with CVS Health, do we see much company risk to the dividend being cut? Not really. If there's not a lot of risk to the dividend being cut and it stays stable, how much higher does that yield go on something like a CVS? Meaning, how much lower does the stock go? Probably not that much lower. Even now, 10-year Treasury yields are paying around 3.92%. As of today, specifically, I was just going off of memory, 10-year Treasury yields are up 10 basis points today at 3.925%. So something like a CVS Health that is trading near 5-year lows, the pretty much same levels you were at during the COVID lows, with a 4.5% dividend, starts to look attractive even at that yield. And that's just one company for an example. And I do think you have a little bit more perceived safety in some of those dividend payers than you do in other growth stocks, especially if we do head into a more recessionary period. But personally, I still want to keep like 30+% cash. I feel comfortable in cash right now. I do want to give the bulls a little bit of credit here though. If you just chart a downtrending line connecting the prior peaks, the all-time high, the peak that you've seen right here on August 1st, and then the high of the day yesterday, you get an almost perfect downtrending line here with 3 connecting peaks, and you gapped up above that today. That is a very good sign, at least in the short term, that even if we do get downside, it could be minimal. And coming next week, we don't have much as far as economic data. There's really not anything. There's some Fed speakers, some data out of Japan. That will be important considering the Japanese meltdown that we recently experienced. You have the FOMC minutes next Wednesday, S&P Global PMIs Thursday, initial jobless claims again next Thursday. On Friday, you have new home sales, but really there's not much for next week that is really going to move the needle for markets. Coming tomorrow morning, you have building permits that come out at 8:30 in the morning. The more building permits, the more building, the more housing, potentially less housing inflation. So from that standpoint, building permits are sometimes important, especially if you see big jumps. Not expecting that. We're actually expecting they are going to fall. I don't think that is a big downside catalyst though for markets either. You have Michigan consumer sentiment preliminary numbers for August. You're expecting the headline number will actually move up from 66.4 last month to 66.9 this month. 5-year inflation expectations expected to remain stable at 3%. 1-year ahead inflation expectations expected to remain stable at 2.9%. Both of those figures same as last month. What the markets really want to pay attention to, though, is consumer expectations. You're expecting those will actually get worse from 68.8 down to 68.2. And Michigan current conditions are expected to also fall from 62.7 to 62.3. Now, this is not just the Michigan area. That is my home state where I'm recording this video right now. It is the University of Michigan's consumer sentiment report. So this is a report on the national current conditions, national consumer expectations, not just the state of Michigan, and I would like to clarify that. This data does come out at 10 o'clock in the morning tomorrow, so 30 minutes after the cash open. And this data does tend to move the markets quite a bit, but it doesn't tend to be something that has a multi-day effect on markets. Walmart CFO on the conference call says, quote, "So we did not see step down. Our outlook for the back half of the year is really for more of continuation of what we've seen. Even in the first couple of weeks of August here, things have been remarkably consistent." Ryan Dietrich posted this on X. This was my thought exactly as well. He says, "Why is the non-voter Goldsby is warning about the need to cut before the labor market weakens, while the voter Bostic is willing to let the labor market crash and burn before accepting that inflation is last year's problem?" And I guess the answer is he is from Chicago, according to Ryan Dietrich. And just so we're all clear, this was the best retail sales month over month since January of 2023. Household wealth increased substantially faster under Trump than the current admin, but the much bigger difference is in the inflation-adjusted change. It was about 9 times faster under Trump. People's household wealth grew by 27.9% in those 4 years. The last 4 years, household wealth has only grown 3.2% when you adjust for inflation. Sven Hendrick asks a great question on X. He says, I'm curious, how can companies sustain earnings growth with negative trending and or flat industrial production growth? And that's a very good question. The last time you've seen, this, I guess, flattening out was before the dot-com bubble. And also before the great financial crisis in 2008. The next big catalyst is going to be NVIDIA earnings in 2 weeks on August 28th. And the VIX is now down on the month and the lowest since July 2023. Another big area of concern is China, with M1 money growth down 5% year over year and nominal GDP growth of 4.9% year over year. The historical relationship suggests there is risk to growth in China. Charlie on X provides great context to retail sales. He says U.S. retail sales increased 2.6% over the last year, but after adjusting for higher prices, they were down 0.4%. Both of these numbers are well below the historical averages of positive 4.6% nominal and 2% real growth. So I guess it's really how you look at these numbers, if you adjust for inflation or not. The numbers that we get from the government are not inflation adjusted, so Wall Street does not tend to adjust for inflation, but in actual nominal terms, how many goods are being bought, retail sales are still not in a great place by any stretch of the imagination. So just in conclusion of this video, is this really the end-all be-all? The economy's heading for a soft landing? Of course not. Far from that. We have many, many more months of data before that conclusion can be made. And I think we need to get the Fed funds rate cut like 2% from here before markets are really going to start to even consider the end of what could be a hard landing or a soft landing. I don't think we're going to have any decisive conclusion on this for many, many months. And I think one set of data is not the way you want to look at this. If you were bearish yesterday, you should still be bearish. If you were bullish yesterday, you should still be bullish and maybe a little bit more bullish. But this really doesn't change anything from the longer term perspective of our markets. And I think the risk to reward in stocks still remains unfavorable, at least until mid-2025, when Wall Street starts to look forward to 2026 earnings, and as long as those can hold up some impressive growth rates. But I mean, you're still priced for perfection for 2025. But I do think in the near term, this was constructive. And until we get the next big set of data, which doesn't come even next week, it's going to be the following week after that, Jackson Hole, NVIDIA earnings, the next, I believe, non-farm payrolls report, all of that is not next week, but the week after that. Between now and essentially like a week and a half from now, we could probably make our way a little bit higher for the S&P. I doubt all-time highs are in play here, but it's possible. With that said, let me know what you think about all of this information down below in the comments section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.